Well, hello everybody, welcome back to another edition of the Forex Weekly Forecast. My name is Alexander Nikitin, and if you are new to this series, what we are doing here, we are looking for some good opportunities that may happen next week, and also we have a little bit of education. And last time we were discussing different types of Gatli pattern, Gatli strategies, Gatli approaches, whatever you call it. Gatli formations maybe. Uh, well, and I showed you many approaches of that. Also, I showed you my approach. If you want to look this video, just look left top on your screen. There is a link there to my previous video. So hope you will enjoy it. Okay, so the topic of today's discussion is backtesting, because I suppose backtesting being the most important thing of your learning of your trading career, the backtesting. After you've done backtesting, you've done at least the half of your work. If you didn't do a backtesting, you didn't do even the half. Okay, so what backtesting means? Backtesting means that you have some kind of strategy. You first need to write down the rules. First of all, it is very important. You need to write down the rules, and you say, I will buy here and I will sell here. My take profit is here, my stop loss is there. So when you will do backtesting, you will look at your rules, and every time you will check your rules and the situation in your backtesting. Okay, how it is done? You go to here, back into history. That's why it is called backtesting. You go back into history, yes, and then slowly, bar by bar. Let me see if it is working this way. Bar by bar, you just moving forward into the future. Just going this way, one bar, next bar, and so on and so forth. When you see the situation when your rule says to buy or to sell, you just buy it, sell it, and what you need to do, you need to record that. You need to calculate the amount of pips you are risking. You need to calculate the amount of your potential reward. Then you need to see if you won or you lose, what was the outcome, and after that you need to record if it was a loser or it was a winner, your trade. And also you need to write down the trade, and you need to save the screenshot of that. You need to write down your time, sorry. You need to save the screenshot of that, and also try to describe all the surroundings of that maybe pattern or whatever you are testing, the surroundings of that pattern. For example, if you are trading XABCD patterns, you can say, okay, let my XA leg be at least the second leg of a new trend, or it could be the first leg of after the false breakout, or it could be the first leg after the break of the double top double bottom neckline, or something like that. Just write down some rules, some surroundings, explaining that. It will be very useful when you will analyze that. Okay, so why do you need to do a backtesting? The first and the most important thing, the backtesting is done to acquire confidence. What is confidence? Confidence means that you are sure that your that your strategy is generating money. Why do you need to be sure that your strategy is generating money? Because the natural thing of trading is drawdowns. Drawdowns, sorry, if we think of it as plurals. Okay, drawdowns. whatever strategy you use, you will have drawdown. Just imagine this fact. There is no strategy that will guarantee you 100% winning trade. No strategy will guarantee you that. If you heard somewhere that there is a strategy that is 100% correct, it is a bullshit. You should never trust those people that say the whole approach may be 100% guaranteeing you money. For example, I know that my approach is 100% profitable, but it means that I need to do at least 100 trades, 200 trades in the long run. It is profitable. I will guarantee generate money. I know that, and I really do that, but I don't know if my next trade will be a winner. I don't know that. It's not a guarantee. The long-term outcome is guaranteed. Yes, I know that in the long term my pips will be generated, my dollars will be generated, but I don't know what is the outcome of the current trade. So if somebody is telling you that the next trade will be a winner because it is guaranteed, because of this, because of that, you should not believe it. Do not trust these people. Do not spend your money to buying those strategies. They are not good. Usually they are not working. Okay, so every strategy has a drawdown. I stopped from this point before I started describing you that there are no strategies with 100% outcome in each trade, 100% trades being profitable. Okay, every strategy has a drawdown. Some of them has less drawdown, some of them have more drawdowns. It all depends on the kind of strategy you're using. Okay, if you find the kind of strategy that is 90% correct, it means that 9 times you are winning, 1 losing, 9 times winning, 1 losing. But usually it is not happen this way. It may happen that 9 times winning and another 9 times winning, but then 1 losing and another 1 losing, something like that, because winners usually tend to come into streaks, and losers also tend to come into streaks, and there is a psychological reason for that. I will explain it to you a little bit later in my later videos, when I will talk about psychology more and more in future, because it is the most important part of trading. Okay, so go back to backtesting. Go back to backtesting. And yes, just imagine that 9 losers, 9 winners, 1 loser, yes, and you have 20 pairs portfolio. Is it possible that every pair, that each of these pairs of these 20, sometime, can you just imagine that they give you a loss at the same time? All 20 pairs give you a loss at the same time. So it means that you will have 20 losers in a row at the same time. That's it. 20 losers in a row at the same time. Even if you have a strategy that is 90% correct, there can be a situation when you have 20 losers in a row because you are trading many pairs, 20 or something like that. If you are trading 100 pairs, 100 markets, you can easily have 100 losers in a row. It can happen, believe me. I had those situations. Then my large portfolio gives me larger drawdowns that are not typical for my strategy. Okay, so next, you will have a drawdown. So the next thing, when you do your back testing, you train your eye. You train your eye only to grasp those opportunities that are consistent with your rules. You train your eyes. When you train your eye to grasp those opportunities that are consistent with your rules, that makes you better and better and better in grasping those opportunities, and what it gives you, it gives you a skill of doing your trades the same and the same way. You are doing your trades the same and the same way. Why it is so important to do the trades the same way? Why it is so critical? Because of probabilities. If you have that 70% probability strategy, and you will say buy here, sell here, stop loss here, take profit there, then what you need to do, you need to execute your trade absolutely the same way it is written in your trading plan, and it is supposed to be executed. If you are executing your trade a bit deviating, your results will be a bit deviating. They will be not exact as your backtesting says. So if you've done lots of backtesting, you acquired lots of experience, you've trained your eyes absolutely good, so this is a guarantee that you will execute your trades the same way. I mean, because I know many people are doing backtesting of these strategies, not by themselves. They are doing the backtestings, programming the strategies and into backtester, something like that, strategy tester, or automatically testing the strategy, not to spend time at looking at markets and so on. So they just do not train their eyes. And even if that strategy tester says that the strategy is profitable, yes, you start trading and your eyes are grasping the opportunities that look like those that are in your trading plan, but that are slightly different, and this slightly difference makes your results slightly unpredictable. And because your trades are deviating from each other, you maybe start from one pattern, trading one pattern, and slightly deviating, you can find yourself, okay, I'm trading absolutely opposite pattern, absolutely conflicting pattern that I should be trading. Okay, so it is very critical that you train your eye doing backtesting. There are also some firms and companies that will do backtesting for you. You just write down the rules, explain your ideas, and they will backtest that. You pay them money, and they will tell you, okay, the results of that your strategy are this and that, and it is working, maybe not working. This is done when you want to make a decision if the strategy is working before you buy it. So you go and hire some people that will do backtesting for you. Absolute nonsense. You are not training yourself. So do backtesting manually. Find each trade in this manner, bar by bar, this way. It is very time consuming. So if you want to become a good trader, you need to do that. If you didn't do that, that means that you are not ready to sacrifice your time, sacrifice your effort. You just don't want to become a trader. If you really want to become a trader, you need to do this. Need to do your backtesting. Okay, after you've done your backtesting, yes, you have saved your screenshots, you have you've written down the results of your trades, how many pips you're generating, so on and so forth. You need to analyze your results, and you need to find some things that are common in those winning trades, why these trades are winning, what is so common about them, what is the environment they are situated. And you also need to look at your losing trades. What is so common about your losing trades? Why they are losing? Maybe some environments they are situated in, or maybe something else. And then if you find something that will give you an idea, okay, something common is this, that makes all these patterns be winners. Let me test this specific feature. For example, I am trading those XABCD patterns, and the pattern will be different if this leg of X to A is different. So to a pattern be, for example, if this XA leg is at least the second impulse of the trend, then you have about 50% to be correct that price will go to hit your A point before it hits X, about 50%. So I mean this, like this, from boom to boom. Before it goes to X, X means your stop loss. This is how I trade. If your X is something different, if it consists of several impulses, like that, if it consists of this, then you only have about 30% of the same particular outcome. See what I mean? You only have about 30%. Why is it so? Just look at this. Boom, boom, boom. What do you see? Left shoulder, head, right shoulder, boom. You can have a little of pullback like this, and then this. If you take targets at 382, it may be winner pattern, but if you are looking for a point retest, no. So the pattern becomes absolutely different outcome. So depending on what is your XA leg, this is how you can see the absolutely different outcome. Your rule says, okay, my B point should be this, my C point should be that, but if your XA is different each time, sometimes it is one impulse, sometimes it is two impulses, sometimes it is a double top break of neckline impulse, sometimes it is a retest swing, sometimes it is an ankle leg that is called a corrective swing, the same as ankle leg. It means that you are trading different strategies. Different XA means different strategies. Every one of them has its own probabilities. This particular XA with the followed by these ratios means this probability. Next particular XA followed with the same ratios that previous means different probability. And the third particular XA, even if it is followed with the same ratios, has the next probability outcome. So you need to backtest this variation of XA, that variation of XA, and the third variation of XA. So if you have 20 pairs, you need to find at least 100 trades to see if the strategy is working for one strategy, for one pattern I mean, and for one pair. 100 trades examples to see if it is working. If you are going to trade 20 pairs portfolio, it means that total you need to find 2000 of trades. After you have found 2000 of trades, you need to look at them and see, okay, what is so common about winners, what is so common about losers, and then you go and backtest again. You backtest checking if the idea you have found, that idea that makes a winner to be a winner as you think it, some common feature of winners, you go and test it once again, another 2000 of trades, and then you go to have an idea why losers become the losers, what is so common about losers, and you test it once again, another 2000 of examples should be found if you want to trade 20 pairs portfolio. So overall 6000 patterns. How many of you did that? I think nobody. Otherwise you will not be watching this video. Otherwise you don't need to watch it. Okay, so after you've done at least 3 rounds trying to optimize your strategy manually, 3 rounds of backtesting, after you have found at least 300 per pair, 3 rounds means 300, then you need to write down, correct your rules that you have written before your backtesting. You just according to your second round of backtesting, third round, you just do some slightly changes in your rules that are written there, and this is the way you do your trading plan. Then you just add in this filter, add in that filter, but before you add some filter to filter some trades, you go back into history and you check if it was working. At least 2,000 of examples should be found if you want to trade 20 pairs portfolio. Okay, so when I told you that every strategy has its own drawdown, yes, you need to understand that there are at least 2 kind of drawdowns, and I will give some credits to Akil Stokes that calls one drawdown to be a natural drawdown, that is a usual drawdown, some probability of having a losses that your strategy generates. And the second drawdown is a psychological drawdown or emotional drawdown, or the drawdown that is caused by you, by self-sabotaging or something like that. So either natural or psychological. And your backtesting helps you to differentiate between these drawdowns. For example, your backtesting shows that you for a long period of time never had a loss, never had more than 5 losses in a row. And of course, if you have 6-7 losses, you should stop and think, maybe the cause of your drawdown is you, not the strategy, but you. Okay, and of course, if you know that you can have about 6-7 losses in a row and it is natural for your strategy, so when you have 1 loss, second loss, third loss, you do not have any emotions. You are keeping silence. You just stay calm. But if you didn't do a backtesting, how it is done usually when a person starts trading but it didn't do any backtesting on his own. For example, you have bought a strategy, somebody told you it is working, and you started trading. You generated a little bit of pips, and then a loss came, then another loss, and you say, what? Okay, what I should do? Maybe this strategy is not working. Maybe that guy deceived me and he sold me some bullshit. Maybe I need to try to fix something. Maybe I'm making some mistakes, and so on and so forth. The only reason you have these thoughts is because you didn't do a backtesting. If you do a backtesting, you have trained your eyes not to do mistakes, and you know for sure that you are not doing mistakes, that you're executing your trade perfectly. Okay, if you have done your backtesting, yes, you know for sure that your strategy needs no improvements. If you have a drawdown, you don't need to look how you should improve your results. If you are thinking of how can you improve your results, it means that you did not enough backtesting, because trying to improve your results will lead to catastrophe. This is the interference that you have into your strategy. For example, trading this patterns of that, yes, your backtesting shows these results when it says this and it says that, and you go and say, okay, I have a period of losses, maybe because I take every pattern. Maybe I shouldn't take every pattern. Maybe I should filter them looking at RSI being overbought or oversold. and you start trading looking at RSI, and the results become different. Maybe you have a drawdown even more, or maybe accidentally you have a winning some winners, maybe. But what is the most important thing? When you have a drawdown even more, you just lose your account, and this is the usual outcome all the traders have. But when you have a winning streak, you start automatically thinking, okay, you know what, this RSI is really good stuff. Let me always use this RSI. But this is the so-called the law of small numbers. The law of small numbers. That means that you had one winner, second winner, and number 3 winner, and that's enough for you to say, okay, RSI is working. RSI is helping me to filter losers, and so on and so forth. But to have a really good, reliable statistic data, you need at least 100 examples on one pair. And if you are trading 20 pairs portfolio, you need 2000 examples of that, of some before you can say that RSI is working or not. This is the truth. So people would better rely on small numbers but not on larger numbers. This is the problem. A good professional trader is thinking a long perspective. He's thinking large numbers. He knows, okay, I don't know if this particular trade will be a winner or a loser, but I know that after 100 trades I will definitely generate some pips. This is a guarantee that after 100 trades I will definitely guaranteed generated some pips. But I don't know if I will generate these pips this time. I don't know if this particular outcome will be a winner, and I don't care if it is a winner or not. So this is how the professional trader thinks. Okay, how he knows that? Of course by doing backtesting, and of course trading after that real time. If you didn't do backtesting, you will not survive those drawdowns. You will automatically sabotage yourself. You will start thinking that your strategy is not good and it needs some improvements, and so on and so forth, and your hands will be itching to change something to have better results. But if you have done backtesting, you know that the best thing you can do, you need to execute your trades exactly the same way they were supposed to be executed in your backtesting. Exactly the same way they were executed last time. So you need to continue executing your trades again and again and again, no matter what happens. So I think that's all about backtesting. Hope you guys understood the necessity of backtesting. You understood the necessity of manual backtesting. And let's go to have some analysis on for the next week. Okay, what is that? Aussie dollar 240. Okay, I've drawn some lines. They indicate my corrective swing, impulse swings. And okay, we have that picture being this. Recently we had a kind of uptrend, boom, 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 several impulses. And here, maybe I explained it to you in my video. Yes, I explained it to you in my video reading the price action structure. After you have a read swing like that, and then a correction that is relatively smaller than the previous one, then you have a read swing again, and the, usually this formation is called the wedge formation and is broken to the downside. Okay, let me draw it back like this. After it was broken, it usually goes to retest your broken line of that. If boom, if you look left, it is the border of that wedge. So it was a winning wedge for those people who is trading wedges. For me, what this indicates, we have that confirmation sign of bearish momentum, we had that correction of this, and now we have the continuation of the downtrend that looks this way. Why do I know this is a continuation? Because this impulse, the second impulse, has a close below the previous one, like that. So when I have the situation of that, when my next impulse has a close below the previous impulse, I just look at the termination point of that, draw some horizontal line of this impulse and say, okay, this may be a kind of structure. Where is the next structure below this? And I draw it this way. Boom, boom, and boom. Yeah, the zone between the close and the low. And I say, okay, if this was the second impulse, yes, so there is a very good opportunity that the movement will be extended at least to this, to the next structure level, to the next level of support and resistance, like that. Boom and boom. So how can we get there? Either we can get there straight of this, yes, or we can have a little bit of pullback to test the previous structure resistance that now, support, broken support that now should be turned into resistance. So just imagine you have a pullback of this a bit too higher into this zone, and then it goes back, and I expecting it to go to the next structure level, exceeding that impulse. Because this impulse has a lower close, it tells me that we will most likely have an extension. Okay, so if you are following me, you start automatically automatically guessing what I am looking at. What opportunity is this? Let us apply some XABCD tool to see some ratio. B point is 554. You can call it bad pattern or something like that. C point is 677. It is also good for my rules. And my D point is usually 786. I do not have a D point of 886 as bad patterns, because it is not a bad pattern. It is a unified Gartley pattern, which is my own way of trading. 786. Let me apply some fibs to see what are the potential stop loss, potential take profit we can have. Okay, one is my stop loss. Boom, 786 is my entry. Let it be this way. This is my entry, 786. This is my stop loss. Let me draw some rectangle to show you the zone, and I will will call it red zone. This zone is red only because if I will sell here, price goes against me, it means that I am negative. Being negative means let me do some color. Being negative means not good, so it is red. This is my stop loss, and the potential target is all the way down to here, to this. I will tell you it about 1 versus 4. And I call targets, I like targets look green. So if I have winner, it is green. It is going green. So the plan for the next week is to wait until price goes higher, until the entry is triggered, and then place our stop loss and take profits, and wait, either stop or take profit is hit. Okay, so I will not see this as my targets. I dislike those huge targets. I would better see for some shorter targets. Okay, no, sorry, I took wrong thing. I like these targets more. Boom to boom, and to this. So my usual target, at least my first target, is here, and the risk to reward is $1 versus $2. You can check it. One, almost two, maybe two, maybe a bit, almost two, 1.6, 1 point something. Okay, the risk to reward is about 1.7. Let it be this way. And if it is extending, what is this level? My eye says it is 127 to 124 extension. Let us check it. X to A and back again, and you see it is exactly 127. How do I know that? Before I measure it, I know this because I've done lots of backtesting and my eyes got trained very well. Okay, so looking for this kind of movements, but I would take targets here to have better probabilities. Smaller target, better probability, better accuracy. Larger target, less probability. So it will maybe we will have some problems getting there, but the general prediction that it will go there, and I will take my targets halfway of this. Yes. Okay, so this is the idea for the next week, Aussie dollar. This is the explanations of how I do my analysis. If you wanna, I will repeat that. I'm looking at an impulse, correction, and the second impulse. Second impulse should have a close below the previous impulse, so that means that most likely we will be extended. And I look at the point of the end of the impulse, final point, and then I look left to see what is the next potential structure, the next potential level where the price is most likely to go. Then I measure it with my Fibonacci's, and then I plan my trade according to this. How can I get involved? If I have this, then I have that. If then process that, trading powered Kill Stokes and Jason Stapleton talk more many times of that. If then process, I mean. Okay, if price do this, then I do that. So guys, hope to see you next week. If you like this video, press the like button, subscribe to my videos, to my channel, and if you have some questions, drop me a line on the trading view or here in comments. I usually answer to every comment, so don't be timid to do that. Leave me some feedback if you like it or not, and I will of course read it and think of it. Okay, until then, good luck, good trading. Hope to see you next time on next Sunday.